And this is why I'm saying that it may be the most important planning issue in your financial future. Your question should not be, should I buy a stock or stock A or B or a stock versus a municipal bond? Nor should it be, what is the best mutual fund in my 401k? What you should really be asking is, how do I position my family for the greatest demographic change in history? In the perfect demographic storm, accepted or conventional planning is saying, keep following the same methods as that previous generation. It's okay to buy that municipal bond or that stock or that mutual fund. Try to max fund your 401k and pay off your mortgage as soon as possible. Follow the same methods as your parents did and you'll be okay. But correct positioning might say, avoid deferring all taxes to the future and limit your 401k to just the company match. And if you're a business owner or if you work for a company where there is no company match, don't even participate in the 401k. Don't even start a qualified plan like an IRA or a SEP IRA or maybe even a Keogh plan. And build assets that allow you to retain liquidity. Make sure that you control and use your assets and only choose assets that you do not have to pay taxes on in the future, or more importantly, only choose assets that do not force you to deplete or liquidate the value or the growth of your account when you actually need to access your money. A higher tax and a higher inflation environment is the worst possible way to position your money. Why? Because no one knows what the future tax brackets or future tax laws are going to be like when you retire. And this trend is irreversible and, of course, very long term. You know that calm before a storm? Well, we will no longer experience a calm before this perfect demographic storm. Baby boomers have already started to retire this year, year 2008. So the calm before the storm is definitely over. And after this year, it's going to take off and it's going to keep going. So the question that I would like to ask you is, when is it that you want to understand that this is going to impact you and your family? When do you want to get it and position your family? With that understanding, let's talk about the retirement plans. So the question that I could ask is, if what you thought to be true about retirement planning turned out not to be true, when do you want to know it? When it's too late, or now, when you can actually do something about it? When accumulating assets for retirement, what we saw our parents do is max fund their retirement plans with its impact on their retirement. They caused the distributions at retirement to often be taxed at higher rates. They also caused their Social Security benefits to be taxed as high as 85% of their payments. So after years of helping people plan for their future, I asked them the question, why do people invest in these accepted or conventional plans? And the answer that I got was always the same. Is it because we get an income tax savings and we get tax deferred accumulation? Well, let's look at that. Let's say that you take $4,000 and you put it into a qualified plan like an IRA or a 401k. Let's say that you're in a 30% tax bracket. Most people think that they're getting an income tax savings of $1,200, 30% of $4,000. Well, that's wrong. That's not correct. What we get is income tax deferral. We can either pay now or pay later. So it's not a savings. It's just tax deferral. We defer the tax, but we also defer the calculation until when? Until we retire. So what do you think tax rates are going to be when you retire? Do you think they're going to be lower, higher, or stay the same? If you recall our conversation on demographics, we think that tax rates are definitely going to increase and rise in the future. So let's look at this closer. Let's say that you have some type of IRS qualified plan like an IRA, a 401k, or something. You have a partner, and that partner is the IRS. And that IRS controls the tax. And they're going to tax all of the contributions that you made over the years into that account. And they're also going to tax you on all the interest that your account has earned over the years. And your partner reserves the right to tax you at some unknown tax rate. So depending on your tax rate at retirement, less and less of these dollars are going to be yours. And they're not saying that you don't owe the tax, they're just saying you can pay it later, but at what tax bracket? So when we look at the conventional reasons for choosing these retirement plans, we now understand that there's no income tax savings at all. There's only tax deferral. If you put $4,000 into a 401k or an IRA at a 30% tax bracket, and you're going to get $1,200 of income tax deferral for that year, we might think that we're getting a great deal. But let's say that we do this for 30 years and we accumulate a little over $400,000 in your 401k. What we've done is we've deferred $36,000 in taxes. At retirement, let's say that you take an annual distribution of 7%. You're going to have to pay the taxes on that distribution, and what you're going to end up doing is you're going to pay $169,000 in taxes when we originally only deferred $36,000. So do you see that the tax savings that we enjoyed for 30 years was actually paid back in about 50 months? So who won out of this deal, us or our partner, the IRS? So you see, these plans are not what we thought. We didn't save any taxes. Even if our future tax rate stays exactly the same, we're going to pay about 4.7%. And so you can see that if our tax rates actually go up, less and less of our money is actually ours. And so what we thought to be true about our retirement plan is actually not true at all. 4.7 times more in taxes, even if our average tax bracket stays exactly the same. Instead, what if we do this? Let's actually pay the tax on the $4,000 today, which means that we pay $1,200 today and we have $2,800 to put into, let's say, our family bank account. And one of the investments that we have inside of our family bank is going to be a fixed equity index life insurance policy. And we want to set this up to maximize our cash and minimize our death benefits. And let's do this for 30 years. Well, at the end of 30 years, if we would have had our 401k, we would have had a little over $400,000. And if we would have taken a 7% annual distribution, and let's say that our tax bracket is exactly the same, we're going to pay a little bit over $8,000. And we also have to know that part of our Social Security benefits are going to be taxed. This would leave us with $16,210. But if we would have had a family bank account, first of all, we don't have to worry about any income taxes, and we could actually keep 100% of our Social Security benefits that we probably paid into that system for over 30 years. So the distributions from the IRAs or the 401ks, not only are they going to cause our Social Security benefits to be taxed, but we're also going to be penalized if we make too much money. But if we would have put that money into our family bank, we'd pay absolutely nothing on Social Security. So in the example that I'm getting, our spendable income tax on the exact same money could be $22,000 instead of $16,000. This is a 37% increase in annual income that you can spend any way that you want. 37% increase. Just imagine your life right now with a 37% increase in income. By the age of 85, this is going to be over $100,000 more in after-tax income. So again, what our parents did was max fund their retirement plans their entire life, but they had a lot of tax consequences. And what I see baby boomers doing today is max funding their retirement plans with potentially even more devastating tax consequences. So my message today is, do you want to have all of your retirement eggs in one basket? One giant taxable basket? What do you think those tax rates are going to do? Consider diversifying some or all of your retirement savings in your own family bank, utilizing the insurance concept.